Hi, students. Today we're going to talk about how to analyze a company from A to Z. We went through all the models, but now it's time to go A to Z to analyze a company. You will have an Excel file. So now I'm going to show you how to analyze a company from A to Z, but we're not going to dig into each model because we've done that in the previous classes. Now I'm just going to tell you, okay, now we finished the models, what we're going to do next. And then I'm going to tell you about the outline, how to present your midterm project. So what I expect in your outline project. I will talk about that. Also in Canvas, you will see a sample of students who has slides and online and video how to do this. It's going to be a short video, but a fun video. So as you see here, you see key financial parameters. And you put for every company, for example, Apple 153, the current price, SD, the analyst recommendation, the RF we expect. Notice here I report the things that you will need to insert, like analyst recommendation for Apple. If you have to analyze a company other than Apple, so you need to insert the price for the company you analyze. This is just don't touch it. This is you have to insert. This is don't touch it by the Federal Reserve. This insert how much beta for Apple in this case. The projected return for the S&P is 10%, so don't touch it. Current PE for Apple, future PE for Apple, you have to add them. Growth, long-term growth, that's for the dividend model. And then for the DCF. So you put the numbers that you need to report here. Obviously, all of this you have to report. The number of stocks. Be careful here. Every company has different number of outstanding shares. So you put these numbers, they will go here to the model. You go here, here, main. And then the price, projected price for every model here go into the main. The ratios 153.11 go into the main. And all of this coming here. Now, today's video is about the main. After you analyze all the models, all of them are making sense. This, you're done with all of those. Then the question is what is the price of Apple 12 months from now, projected price? You have to put the weights, how much weight you have to put. First of all, you have to make something called I-test. What does that mean, I-test? The price of Apple is 153 now. So this number here, it's too high, 415, too high. Maybe we have 1% here, maybe. And then the overall risk, the overall weight become to be 105. So I need to take it somewhere. Maybe I put this here 14. All right. Or maybe 13 I can put here. 10. Let's make it 10 here. 5 here. So I-test. So this one is the most awkward. So I'm going to take some. I'm going to give it little weight. I put a lot of weight for analyst recommendation because these are the expert. I put a lot of weight for the ratio models. Very well known. The CAPM model. Very interesting. These are solid models. This one is very subjective. We did a lot of assumption here, the same here. So the current price for Apple is 153, projected price 176, 176. You put that here, 74. Okay. So what is that? Well, that means a return of 15.5%. But we expect is that should we buy the stock or not? It depends on the S&P. If we expect the S&P to do 20%, then Apple is not a good stock. But we expect the S&P to do 10%, then the excess return is 5.5. That means it's a buy. We recommend that to buy Apple. So here I did for you a decision making. If the excess return of the company is fairly near above the S&P return, projected return, then it's a strong buy. If it's near, weak buy. If it's slightly below, strong hold. If it's way below, 75% of it low, then weak sell. If it's way below the S&P projected return 10%, then strong sell. These are my decision rules, but you feel free to use it or not. Are we done? No. Now we start actually. So now we say the price is 176. We expect the current price 153. We expect the future price to be 176. Now we need to do something called sensitivity analysis. What is that sensitivity analysis? Finance is an art. It's not a science. It's not like physics, E equal mc squared, the relativity theory for Einstein, or gravity is 9.8 from Newton. No, finance is an art, and we put a lot of opinion, a lot of subjective opinion. So everybody has opinion. And the question is, we need to do some sensitivity analysis to see how much our opinion sensitive to our subjective valuation. So how we do that? So the current price, projected price, 176.74. So it's a buy. Because you are a buy, then you're gonna say, look, maybe I am over optimistic. That's the reason I am buy. So what you need to do is to say, what if I am less optimistic? What you do, you lower 10% from every parameter you use. You lower 10% to show that less optimistic 10%. If that change your recommendation. The first one you can do is analyst recommendation. It's 4, very high, strong buy, in the near strong buy. So what if it's 10% less than what it's supposed to be? So 10%, so this times 90%, which is taking 10%, that would be 3.6. If you said, well, maybe the analysts are too optimistic. If I'm lowering 10% optimism, what would happen? Well, we're gonna put from where the 10%, it's my rules, 10%. If you wanna do sensitivity 20%, then you even more you go. I think 10% is fair. 3.6. If you go 3.6, then the price will go down 0.35%. It will go down a little bit, but not a lot. That means, since is this sensitive? No, it's not sensitive. We still buy. That means even though we lower the optimism of the analyst by 10%, we still buy. So sensitivity analysis, you lower the optimism by 10%, and you show that even if I lower the optimism by 10%, I still buy. So if for example, you lower it by 10% and this has become to be sell or not buy, the access return become to be negative, then what you say, okay, it seems my recommendation is a buy, but it's very sensitive. I'm not strongly recommend that. That means sensitive. Now we're going to do another sensitivity. What you do is undo this, and then you say, maybe I'm going to do, well, I give too much weight for the DDM. I'm going to take 10% of that, 5%. So 5%, 5 multiplied by 0.9, that would be 4.5. So I'm going to give weight here 4.5. I'm going to take from the highest price, and I'm going to give this 0.5% that missing here to the lowest price, which is in this case, this one, 144. Now I'm back to 100, and now I'm still sensitive. I'm going down, the price going down by not by much. So the weights are not sensitive. I'm still buying. So undo, I'm going back to the original weight. You can go another possible things to change. What if the we have the beta is too much high? Maybe it's 10% less. We go to 1.2. Then we're gonna see here what it changes. Boom. When you do that, a little bit it changes. Actually, the price going up. So I have to do it the other way around. What if the beta is bigger? 1.4 actually. What happened? If the beta is higher, then the change will be 3.39, big change, but still the access return is positive. So even if I am lowering the analyst recommendation, changing the weights, changing the beta, I'm still buy. It did not change my recommendation. Therefore, I am buy and not sensitive, sensitive to my assumption. Then I do undo again. I go back to the original. I go back here. So that's pretty much what you need to do sensitivity analysis. It was in this case a buy recommendation. If it's a sell recommendation, then you're gonna say, look, I'm gonna increase the optimism. If it's a sell, if your recommendation is a sell, you need to reverse it. And you say, oh, wait a second. Maybe I am too pessimistic. What if I am more optimistic? And then you have to do the reverse. You have to go to the A and R, increase it by 10%. That will be 4.4. And then the price is going to go up, actually. Here, 5.9, the price is going up. Undo. Back to the original one. Maybe you lower the beta. Maybe you change your weight. You take from the highest price, lowest price, you give me to the highest one. 10%, you move the weight. And you see, like, you go down from 9 here to 6 here. And you see if that's happened, would that change your recommendation? So these are the things that you have to do if you are sell recommendations. So you have to increase optimism by 10%. Now the final thing is how to present, and we're done for today. I want to have, and here's the project outline. The first page, your summary, your name, the company you analyze, current price, projected price, and a projected return and excess return. You put that in the first slide. Again, finance is different than Hollywood. Hollywood, they like to put you in a movie so you can watch all the movie to the end. So they keep you 2 hours and you order beer and burger and pizza, popcorn, spend some time with them. They want, if they put the end of the movie in the beginning, you're not going to watch the rest. Here in finance, the opposite. We put the bottom line in the beginning of the presentation. Here's my outline. Here's my recommendation. If it's a buy, it's a green. If it's a sell in red, if it's a hold in gray. And then the rest of your presentation, you explain why you recommend this about the company. So finance is different than Hollywood. And again, I'm telling you, this class, you're not going to see it in Harvard, MIT, Princeton. Because the professors, they're doing maybe better research than me. But they don't know the real world, and they don't know how to analyze a company and how Wall Street operates, unless the professor worked for Wall Street as a financial analyst. Then I can tell that. But if not, they don't know how to do it. This is the way to do it. Boom. You put the bottom line in the first slide, your name and the company you analyze, buy, hold, and sell. For example, if Warren Buffett met you in the elevator and he asked you, what do you think about Amazon? Then your answer should be buy. That's it. And then if you ask you why, then you can tell him the analyst recommendation and this and that and beta and the models. That's fine. But first you have to tell him your recommendation. And then 1-2 page review of the firm, figure about the historical price, review of the company sector. So how you do that? Suppose you analyze Apple, you go to Yahoo Finance, If you analyze a company like Apple, AAPL, you go full screen, and then you compare Apple with the benchmark. Our benchmark is S&P in the past 5 years, and you see the return for Apple versus the S&P. Five years, and the Apple did 247.8, 43.9. And the way I use it, I like to use this snipping tool. You copy that, and you report the results. You put that in your report. That's how you compare. You do the eye test, Apple versus the S&P. So, and then there's another video about how to analyze a sector. I want you to go and use that. Then you have to use US economy. You have to do some Google research about what's expected GDP growth. I think for the US, we expected 2.8. I'm talking about first quarter 23. Interest rate around 5%. Unemployment, I expect the unemployment to go to 3. It's going to be 3.8. You can go to Bloomberg and find these numbers, or research that by yourself, what the analysts think about it. Stock market, 10%. We expect the stock market to go 10%. And then 3-4 pages report for each model results. And then 1 page about sensitivity analysis. and 1 page about your recommendation and conclusion. And here are the slides, 12 slides. Here is the outline for your presentation. I think the presentation should be 5 minutes. 1 or 2 minutes for a question if it's in person. If it's online, there is no Q&A. Just 5 minutes, pretty much you will cover everything. So you can have a presentation 50 minutes, 6 hours, but what's the point? The point is to be short and sweet. Anybody can spend hours talking about the company, but that's easy. The smart person who can put them in a few minutes. So here is the outline of the project. You will have a sample for one of my students who present this project. I like his presentation, her presentation. So enjoy it, and that's pretty much what I have for you today. Now you know the 5 models. Now you put them together, you analyze them, you do sensitivity analysis, outline for the final project. You will have a slides for one of the students, outline, and then video of that one of the students, how they present. I hope you learn a lot today. Thank you so much.